Hello and welcome to the Future Food Finance Podcast. My name is David Stevenson.
And my name is Paul Cuatercasas.
And we are the founders of Future Food Finance. And every couple of weeks, we try and get together to talk about big issues in the world of food tech. And a slightly different format this week, because normally I sort of do a kind of brief preamble around interesting stories on the internet and about the whole food tech space. But actually, we're going to really just focus on one topic. And it's the only topic that really everybody's focusing on at the moment, which is what the hell is happening with the markets? And more importantly, what the hell is that going to do to venture capital? Yeah, because let's be honest, a lot of the food tech spectrum, most of it is not in the public markets. There are some companies in the public markets. They're in our Future Food Finance Food Tech Index, but most of them aren't in there. Most of them are private companies, and it's the private companies that are funded by the VCs, whereas probably most of the interesting stuff's happening. But the problem, of course, is that the public and private markets, though they're not the same, they have a relationship. They do sort of relate to each other because it's all about the capital pipeline and everything. So the obvious $64 trillion question, Paul, I suppose, is it's pretty obvious that the public markets are having a freak out about tech. Basically, tech's getting absolutely slaughtered generally. NASDAQ is down much more than the S&P 500, and the S&P 500's got a lot of tech stocks in. So it's having a bit of a kind of bad hair day around tech and food tech because it's earlier stage than, say, your classic FANGs, gets hit because it's more medium caps, or mid cap, small cap. So, as you'd expect, food tech's getting absolutely kicked. So that's happening out there. This is surely going to have a knock-on effect on venture capital. And I've been hearing anecdotally about deals, particularly Series B and C and D and E, numbers getting, marked down with red ink, as SPACs and IPOs pulled. So that's the late stage companies. Do you think it's going to, it must surely cascade back into the kind of earlier stage, Series A and even seed? What's your read on it? What's your take?
My read, David, is exactly that. And I've lived through 3 or 4 crashes, and that is exactly what happens. It does take time, though. There's a lag, and the lag can be 3 months to 6 months, in some cases 9 months. It does tend to hit the Series D, E, and F before it would hit the Series A, B, and C. But it certainly does flow through, trickle down all the way to the private rounds, for sure. And we're just seeing that now. I mean, you would have seen a few months ago when Instacart announced that it had reduced its valuation, I think, by about 40% in a round to, I think, $24 billion from about $40 billion, something like that. And we are hearing similar things, seeing similar things in the market for other companies of that size. So absolutely, it's starting now, and I'd say that makes the private markets very interesting, and we can talk about that a little bit further if you want. What's your take?
Yeah, no. I was interested in the time scale. So it's sort of between 3 to 9 months. That feels about right. And it's important to understand the kind of way that if you can characterize the capital pipeline works, which is the reason why, just for those who don't understand, the reason why Series C, D, and E get hit is because probably the payoff for a lot of those companies, though not all, is that they want to list those companies if you're a venture capitalist. And obviously, if you can't get an IPO away, then that basically, stymies your listing. I suppose the question for me is how long that's the first question we're going to ask is how long the IPO pipeline blockage lasts. So if we think that it takes 3 to 6 to 9 months for the kind of deep freeze to set in down the capital pipeline, how long does that freeze then last for? And I'll get your view on this. My view on this is traditionally it tends to take about a year or two. Yeah, maybe I'm being over dramatic here, but it tends to that IPO pipeline freezes up for at least 12, 18 months. And it's very difficult to get anything away. What's your take, Paul?
Yes, although every situation is different, just like every market is different. And this one is different from the previous corrections and crashes. If you don't mind, if the audience doesn't mind, I'm going to just try to back up a bit here and reflect with some numbers. So I'm going to be useful to do this, especially when it comes to food tech and some of the companies in the index and how they've been hit. So I'm just going to read out some numbers. This is the 1 year return to today. I'm just going to read out Deliveroo is down 60%. Delivery Hero down 73%. Ocado down 60%. Beyond Meat 75%. DoorDash down 43%. These are serious numbers. I mean, these are crash numbers. Now they are down from the peak, and the peak was really peaky. So that's something to bear in mind. At the same time, I want to point out that many other tech stocks are down in a similar way. So Cathie Wood's ARK Fund is down 61%. Zoom is down, which we'll talk about in a minute, is down 70%. Peloton is down 85%. So there has been a crash from the peak across the board. And I think the big point here is it's not over yet. So if you look at most of these stocks on a 1 month time frame, maybe 3 month time frame, it's still a falling knife, which, as you know, you don't want to try and catch. You want to, as if you're going to go back in and buy again, which comes to your point about IPOs, you want to make sure that it bottoms out, or that you've got a high probability of believing that the evidence is that it's bottoming out. So I think that's the first thing we need to see in the markets before we can see IPOs again in this sector. But I think it's a good time, David, I don't know what you think, to talk about the difference between price and value. As you know, as most market participants know, timing is everything. Timing is everything on the entry, and timing is everything on the exit. And as Warren Buffett famously said, price is what you pay and value is what you get. And as we were talking a few days ago, I think the best way, or one of the best ways, it's a common way to describe this that everyone will hopefully understand, is by looking at Zoom. And Zoom is a company that most people are familiar with that did its IPO in May 2019, 3 years ago, almost to the day, and has had a skyrocketing during the pandemic and has since come back to earth. Now, why does this demonstrate, if you can indulge me for a minute here, why does this demonstrate the power of looking at price different from value? Because if we go back 3 years, May 3rd, 2019, when Zoom did its IPO, the price was $78 per share. Today, the price is $83 a share. It's about the same. The Zoom share price today is about the same as 3 years ago. But what's happened to the company in that time? Let's look at the numbers. Let's look at the P&L cash flow numbers, the fundamentals of the company. So the trailing 12 months of Zoom leading up to May 2019, so this was through April 3rd, 2019, revenue, $392 million. EBIT, operating profit, was $9.4 million. Net income was $7.7 million. And diluted earnings per share was 3 cents a share. The PE, and by the way, the company had no net cash. The PE at the time was over 2,500. Roll the clock forward 3 years to today. And we're going to use the trailing 12 months as of January, because those are the latest numbers, January 2022. We don't have the April 2022 just yet, but probably about the same. So revenue in 3 years has grown from $392 million to $4.1 billion. That's 120% compounded annual growth for 3 years. That's 10 times revenue. EBIT, operating profit, has grown from $9.4 million to $1.1 billion. That's 117 times growth in 3 years. Net income has grown from $7.7 million to $1.4 billion. That's 178 times growth, and diluted earnings per share from 3 cents a share to $4.50 a share, for 18 times PE. Now, the other thing to point out is the company has been generating cash, which is not normal for a lot of these early stage startups, including in FoodTech, by the way, I want to point out. So it's generated $5 billion of net cash, which is sitting on the Zoom balance sheet right now. Last quarter, there was very little revenue growth, which is probably one of the main reasons why the share price has come down and hasn't continued to grow, in line with the market bringing all of these companies down by about 70%. But just to point out, in the last 12 months, Zoom generated free cash flow of $1.6 billion. This is a good company. This is a company that's growing its revenue, it's growing its profits, and incredibly, for an early stage fast growth tech company, it's growing its free cash flow. It doesn't have a lot of expenses. the challenge for Zoom going forward is its product, its solution, how it competes with Teams and some of the solutions that are out there. Now I want to bear with me one more minute, back up to some of the food tech companies that we have known and loved over the last 3, 4, 5 years. And we look at their performance. So Just Eat, which is down 75% share price in the last year, which is now worth less than what it paid for Grubhub, I think about a year or so ago in the US. Just Eat lost 285 million pounds in the last quarter. It's not a Zoom. Deliveroo lost 300 million pounds in 2021 on 1.8 billion pounds in revenue. Deliveroo is down 60%. Deliveroo, not a Zoom. Delivery Hero, which is doing a little better on the profit front, still lost 93 million pounds in the last quarter. These food delivery, grocery delivery, takeaway companies that have gone up during the pandemic are not out of the woods yet. They have fundamentally not been able yet to generate profits or cash flow anywhere near the level that Zoom has been able to do. So I'm not giving any right or wrong here. I'm just pointing out some observations about the fundamentals of these companies versus their share prices and how the share prices have declined, and that price is not the same as value, that timing does matter, and that the key to good long-term investments in general tends to be not to buy when a company is priced for perfection, when everything is going swimmingly well. So, for example, with Zoom, which is a good company, it would not have been a good idea to buy Zoom shares on the 16th of October, 2020, when the shares were priced $5.59, not $82 a share, and market cap was about $160 billion instead of $25 billion. That would not have been a good time. Now, hindsight's everything, right? But this is just, for me, the main lesson of the moment. As I said, I don't think we're finished yet with the bear market or with the declining equity markets. I think we still have a way to go. But I do think this is the time for investors to reflect on, what is my entry price? First of all, what company am I buying into? What is the quality of the company? And when is the right time to buy in? When can I be sure that this company is a good company with sound fundamentals that has a decent probability of continuing to grow and generate profits? So I just thought that was important to point out. And I guess one last point on that is Tesla and GM, or Tesla and the rest of the auto industry. Most people have been in disbelief that Tesla itself has been worth more than the entire auto industry put together. Well, don't forget the fundamentals here of the recent past. In the first quarter of this year, Tesla reported revenue of $19 billion and net profits of $3.3 billion, which was higher than GM net profits. So while I think we think of Tesla as this startup that hasn't really made money, well, it's just produced a quarter with higher net profits than GM, with higher profit margins, with 1/3 of the employees, and with a company that effectively thinks as a technology company. So that's, again, a twist on value and price. And of course, Tesla's share price is coming down now with all the rest. But it's just, the kind of thing to be thinking about when investors are looking at food tech companies, is the fundamentals of the company compared to where its price currently sits.
And I just one kind of riff on that is if you look at a company, the value of a brand, is also extraordinary. So a similar kind of parallel case is Spotify, which I'm a big fan of. It is profit making, but it's not as profitable as it should be. But I think I did the calculation that's basically on its current market cap. It's effectively pricing its 180 million premium customers, which is a big number, at about $100 per customer. And I think in terms of, when you're acquiring a brand, in that case, particularly with phenomenal global recognition and a particularly dominant position in a particular market, brand in itself, the ownership of a large quantity of people who feel loyal to a brand is a remarkable number, and those don't quite translate through into classic P&L numbers.
Which I would just jump in and say, similar with Netflix, these companies have been hit because growth has just stopped. Growth has not been pandemic growth. It's more normalized growth. And so with growth stocks and tech stocks, which is about growth, the market immediately penalizes these companies. And this is something to bear in mind when it comes back to the food tech companies and the food delivery companies. So a lot of the food delivery companies, and especially in grocery delivery, have been operating on the basis of coupons and vouchers. And so they've been handing out, a lot of free meals to gain market share. But the issue, as you point out with brand, David, is a lot of these companies haven't yet established the de facto brand like Spotify or Netflix. Although Netflix as a brand may be at risk from Disney and others who are competing in that space. But if you look at Deliveroo and Just Eat and Uber Eats, Delivery Hero, and then you look at Gorillas and Get Here, Jiffy and Flink.
I think the point what you're saying is quite right. There's just too many brands. And in fact, the issue with Spotify is that Spotify has been able to actually increase what it makes people pay. And by and large, people have stuck with it, largely because they don't have a choice. Well, they do. There's other companies, but they're not in the same league. And that's pricing power. So brand brings you pricing power. Yeah.
Well, it reduces the customer acquisition cost and reduces the churn, and people come back. And the problem in the grocery delivery and food delivery is people are not necessarily coming back. They try it once or twice, or they use it for a year, and then they'll try somebody else or whoever's going to give them the voucher or the coupon. So
they don't have pricing power. And it's, and brand pricing power, margins, that as you said, that constitutes value. I mean, Warren Buffett always says, don't look at a share, look at the company behind it and understand the value consideration.
That's right. And we could also talk about Beyond Meat in that regard. So Beyond Meat has taken a hit down about 75% in the last year as well. And earnings, I think, were announced the last day or two. And, there's some real issues there they're having to reduce price to compete. Their volume is up, but, price is coming down. And while the market is expanding for plant-based proteins and plant-based meat, and Beyond Meat is also doing a good job of expanding its own product offerings into new categories, the fact is that there is a lot more competition entering the market. And it's quite possible that a lot of investors didn't expect this 2 or 3 years ago, that it would be so relatively easy to produce plant-based meat, plant-based protein, relatively cheaply and effectively using different ingredients for flavors. And this is just beginning, as you and I know, David, this is just beginning. And some of the most exciting developments actually in the industry are happening with these private companies that are now doing very early stage rounds, seed rounds.
Well, that's what I was going to come on to, Paul. I was just going to come on. I suppose my last parting thought and question for you is, one of the strategies of working through a kind of a winter for VC land, which you and I both think we probably are probably on the verge of, which might last an indeterminate number of months or years, is one of the ways of surviving that strategy is maybe to go down the ecosystem life cycle, and to stay away from the late stage stuff, because that's going to have a difficult time getting an IPO away, and going down to early stage businesses, because these will probably feel the pain very soon. Valuations will come off, and funding will begin to freeze up. And actually, you quite often find that quite keen valuations emerge at the seed level. What's your take on that strategy, Paul?
Yeah, absolutely, totally agree, 100%. There are phenomenal opportunities across the board, across the entire food tech chain right now in early stage private companies. I tend to talk to a founder or CEO of these companies every day. Every day I talk to at least one or two. And it is amazing what they are able to do with relatively little resource. And it doesn't mean that they don't need capital or don't want to raise capital, but the progress that they're making in terms of growth, growing their revenue, or certainly growing their intellectual property value while surviving on a shoestring is extremely impressive, and it's very exciting. And it's across the board. I mean, there's so many different sectors that are innovating and solving tiny little problems across the value chain that they all add up to really an extraordinary result. And I'm excited that FoodTech, which is what this is all about, is about to move from, and I mean about over the next year or two, from the more visible delivery companies, which is what we've been talking about on this call, because they're the ones that have gone to IPO and quoted, from the delivery companies to the other companies across the value chain, to the lab meat and lab fish and lab pork, to the plant-based companies, to the novel ingredient companies, to the vertical farm and indoor farm companies, to the equipment companies, the picks and shovels companies that are reducing power costs, LED costs for the vertical farms, which is one of the biggest barriers to them. The companies that are delivering new packaging solutions that are eco-friendly, don't involve plastic. I mean, it just goes on and on and on. So it's really, really a very exciting time.
And so basically one of the ways to survive in then is to move down that VC food chain and to start looking at seed capital stuff, because at some point that's going to become much more compelling. Okay, I think we've probably talked too much now, Paul. Let's see if it all happens over the next couple of weeks. Very exciting. We'll be back in a couple of weeks' time. Do remember to keep looking at the website, Future Food Finance, and basically eat well.
And sleep well.
See you guys.